everybody expects me to know the answer to these things because a lot of times I do have the answer. I think most of this has to do with the relief that we got past this Fed move. And let me tell you something. I know, we all know here because we read this stuff, right? That in December, the Fed said what they were going to say today. You know, we're going to look at tapering off, we're going to do a quarter-point rate. But only a few weeks ago, we still had many market participants. I had clients that called me and said, you know, the Fed's probably going to raise 50 basis points or more. And have you heard what Bullard from Dallas has said? This is a classic example where, and I don't want to, throw media under the bus here, but investors and media were so hopped up listening to one lone wolf from the Fed from Dallas talk about his outrageous expectations, this hawkish thing, like we should be up 3%, on the Fed rates by the end of the year, that people don't really look at what the status quo is. The Fed's like milquetoast, it's chicken noodle soup. They tend to just take this like nice, boring path forward, but we want to think that there's more to it because inflation picks up. I also think that there's this idea that peace could break out in the Ukraine, that we could start having talks. There's this hope springs eternal. And then I think you add a little short covering to the mix and there you go. Don't discount what happened in China earlier this week with the government coming in and saying, fine, we're going to blink. We're going to start propping up the stock market. So for those that, were dying and languishing in emerging markets, yesterday we had this big pop. And I think that in general changed the mood now that we have this perception that China's going to play ball with the Western capital markets and not try to continue to have this regulatory issue. Because let's be real. The zero COVID policy kind of makes people in the West nervous as far as China's GDP. But when you look at the actual numbers in China, they're back to pre-COVID levels already. So this was just sort of the icing on the cake. Who knows? I think that we could still go lower and try to test a little bit. I think I want to be in other, some places more than others. And I've started selling my gold as of last week. I want to take that money off the table and add to things that have done well.
And to that point, then, how should investors think about rebalancing at this point, once we see where the Fed is starting and where they plan on going with the rate hikes and the policy tightening as well?
I think you need to be rebalancing to an overweight in the U.S. stock, period. I'm overweight. I'm going to remain overweight. And until I see some more high water marks on broad U.S., not necessarily the Nasdaq, it's got the Nasdaq's like the Fed. It's got a lot of work. But I think you should, if you're not heavy in U.S. small and large value, or you have a smaller position in that, I think that asset class since the beginning of the year has showed what it's made of. I mean, just look at the Dow transports. They're positive for the year. Nobody's talking about this. Helene Meisler, who's like my chart goddess, has been saying all week, why isn't anybody talking about the breakout in transports? I mean, you could be making money right now. And so when you sort of extend that out to the broader U.S. value markets, whether it's large or small, they're only down like 2 to 3% year to date. The Nasdaq's still languishing, down almost 15, and the S&P, is down 8 or something like that. So I think you have to go where money's been treated well this year. I think that you have to remember that if you're heavy in that Nasdaq tech trade, certainly it's going to bounce, right? Certainly PayPal, for instance, this week, very interesting. Amazon's trying to show signs of life, but when you have those type of losses, that type of damage, especially on the individual level, it can become dead money. Just remember about Cisco Systems 22 years ago. Great run up, goes down, bounces, dead money for a dozen years. Don't let that happen to your portfolio.
For those who are looking at commodities and where that could play a role in their portfolio as of right now, where are you advising? Where are you looking at perhaps even adding more, taking some off from your own positions right now?
So here's what I'm doing. Number one, if all you do is look at stock markets, don't think that you're going to be a commodity expert just because you see a squiggly line shoot up, right? I've been trading gold since I was actually gold was the first thing I ever started trading when I was 6 years old. I learned about bubbles back then in 1981. So I've been taking, meaning that, I had bad timing. The thing about gold, it made this parabolic blow off last Tuesday. I got lucky and sold near the top on Tuesday, hoping it would continue, but that's where I took half my position off because I only wanted to see gold above 2,000 an ounce. I'm not like Goldman Sachs here saying, oh my gosh, it's breaking out. It's going to be 2,500 by the end of the year. So I took half my gold off, half my silver, because it got to the level that I thought it was going to back in late 2020. It's taken 18 months to get there. Secondly, today I started taking off a little bit of my gold miners. I'm in junior gold miners. They've had a great run. I hope they go up, but I took off maybe a quarter to a third of that position because when you see this type of ramp up, there's something wrong with commodities. There's something wrong with gold and broader commodities. I think investors should take profits. If you don't have exposure, I don't think this is the time to do it. I think that from here going forward, you can make more money in beat up stocks, especially ones in, as my buddy Tony Dreyer always likes to say, banks, tanks, cranks, and shanks. You know, that value play. And I still think that that's going to have legs between now and the end of the year.
And Lee, just very quickly, we're seeing oil prices now back above $100 a barrel on some of this renewed concern from the International Energy Agency that Russian sanctions are expected to squeeze supply and even lower demand wouldn't offset that. What are you keeping an eye on there?
Well, first of all, what we always have to go back to is look at what the news came out back in December, January, and February. A large minority of OPEC countries cannot meet their targets. Russia has been short 50,000 barrels for months now, right? You have a few places like the Saudis that can increase capacity. So we knew back in December, before Ukraine, just take Ukraine out of it, we're going to have sticky energy prices going into and through the rest of this year, Ukraine or not. Because OPEC, they just can't pump enough. We haven't had enough CapEx, capital expenditures, since the big decline back in 2014. So I think that higher oil prices are here to stay. And, you know, take what you will. If you want to hold on to your Exxon and your energy positions, fine. I just wouldn't necessarily buy them up here. And I think that it's going to affect the European economy. Last year, they spent $1 trillion more in energy costs. Their energy costs are 4 times the size. The Economist put out a great thing a few weeks ago where it was going through, like, you know, they think like maybe we can get 85% of capacity if we shut off from Russia. But look at, like, just Europe is shameful. Look at the UK. They said we're going to keep taking certain things. We're just not going to take all of their thermal energy. Europe, Putin's got by the throat.